What does a leading academic in the field of value investing think about the way we are dealing with investing today? What do we think about capital markets? What's going to happen with inflation rates? What kind of returns we should expect over the next decade? A whole bunch of questions that a lot of people are thinking about right now in the middle of 2026 will be answered. So be sure to stay around while we listen to George Athanassakos of the University of Western Ontario talking about what he sees going on for the remainder of 2026.
This is Make Better Wealth Decisions, a podcast dedicated to helping pre-retirees and retirees manage risk and economic uncertainty by adopting a pension-style approach to improve your risk-return trade-off. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto.
This week, we are speaking with George Athanassakos, who is a professor of finance at the Ivey School of Business at Western University in London, Ontario. In that role, he is also the Ben Graham Chair in Value Investing, and his new book called Value Investing, From Theory to Practice is available everywhere. How are you, George?
I'm good. Thank you for the call.
It's always a pleasure to have you. You're actually one of my favorite people to speak to because I think you and I think very much alike. Not that that should matter, but it's always nice when I can find someone who has a worldview that is broadly similar to my own. So I find that useful. Let's begin by talking about where we are at mid-year with regard to the interest rate cycle. Do you think the period of low rates is over, or will it be coming back?
Yes, I've written about this before, and my view is that trend-wise, interest rates bottomed in 2016, actually, and have been trending up since then. Of course, the COVID paused this upward trend, and if there's a recession, there may be another pause. But I think all this will not reverse the trend. The trend is upwards. You know, from 1980s, mid to late 80s to 2015, what we saw was a dramatic decline of interest rates. And this was driven primarily by positive demographics, by falling inflation, by falling taxation, by positive geopolitical things like deglobalization and the fall of the Berlin Wall, the admission of China to the World Trade Organization, and so on. I think starting 2016, yes, things changed. Demographics became negative. Inflation started to go up, underlying inflation. Taxes, I think the expectation is that at some point, taxes have to go up because this ballooning deficits and debts will not be solved. I'll talk about this more about this in a minute. And also you have, negative geopolitical things. You got deglobalization, tariffs, protectionism. And I want to be clear here. I'm talking about long-term trends. I'm not talking about cyclical. I'm talking about secular changes. And as you know, interest rate, if we forget risk at this point, has two key components: the real interest rate and expected inflation. Now, why do I think the real interest rate trend is upwards? I'll give you a very short economic lecture. So in the long run, the real interest rate trend is determined by the demand supply of capital for long-term investments. Now, what affects the demand side of the equation is technology. As technology comes in, companies need to embed this technology into the production processes, so they demand a lot of capital. The supply side, in the long term, is affected by demographics, me and you. When we were young, 20s, early 30s, we need money to spend, not have money to save. That is, we need to buy a house, to buy a car, send kids to school. We don't have money to save and make investments, so we want to spend. As we get older, now we paid off the house, paid off the car, kids have left home, now got more money to save and invest. So why I say the demographics, the supply side, first of all, has turned negative. Well, baby boomers, which is the biggest proportion of population, like me and you, I guess.
Yeah.
And they're retiring now, or they have retired. And when you retire, you don't save anymore. You de-save.
Yeah.
You de-save. And this will affect the supply side in a negative way. On the demand side, AI related investments, I guess, the overcapacity and demand for data centers, electric vehicle, renewable energy, all this will demand huge amounts of capital. So the supply will be restricted, the demand will go up. So when you show that demand equals supply, real interest have to go up because of the demand excess of supply. And then on top of this, you've got historically, as I said, globalization, increased liquidity in North America. Deglobalization will have the opposite effect.
Right.
Many, as you know, one of the biggest buyers of U.S. securities was Japan. Now Japan and many other big players are not really buying a lot more securities, government bonds, I guess, treasuries. In fact, most of them, they repatriated a lot of them. So this creates an imbalance where the demand will exceed supply, so real interest rates trend has to be up.
Gotcha.
How about inflation?
I think that explains the thesis. I want to move on because I don't want to run out of time. It's funny because I was going to say that I used to always say that the secular trend was from 1980 till about 2022 because I was counting the artificial stimulus coming from rates going down because of COVID. But you're right, in many ways, it actually ended already in 2016, and it's now 10 years since we've had Brexit, and that's when the deglobalization became more of a concern. So I thank you for
inflation also. So inflation will be going on trend-wise.
Yeah.
I mean, AI may affect a little bit like productivity, but I think the demand for capital will be so high that would overcompensate for the decline maybe of inflation because of AI. Eventually, I think the balance will be to higher long-term trends of interest rates. And this, of course, will be bad for growth stocks, right? And all these high-tech stocks.
Right. Okay, so a few moments ago, you mentioned the notion of a recession. I'm wondering what your thoughts are for the second half of 2026. Do you think we're heading for a recession?
Well, I mean, I think everything will be linked to whether there's a bubble or not. I think a bubble is definitely in the works. If it bursts, there's going to be a recession. But it's difficult to guess, I guess, when the bubble will burst. I think, what's been happening nowadays looks very similar to what will happen in 07, 08. The bubble burst in 07, 08 because of the housing bubble that burst. Now I think the next crisis will be by bursting of the AI private credit market. We see already a lot of defaults in the private credit borrower by private credit borrowers. And also going to have another bursting of the AI-induced overinvestment, overcapacity. And of course, if there's a bubble that's bursting, then it will affect the real economy. Now, bottom line is, however, I don't think this year, I don't know about next year, but this year, I don't think we're going to have a recession, primarily because the research I've done indicates that unless the smart money is wrong, we'll not have a recession. So I looked historically, I looked at the stock return between November and April. 9 out of 10 times we had a recession where the November to April returns of the stock market were negative. Well, this year were not negative, were positive. And this seasonality in the markets is driven by smart money. So unless the smart money is wrong about expectations, I don't see we're going to have a recession this year. Next year, there may be a totally different story, and we'll see what happens next year.
Okay, so one of the things that you and I have spoken about in the past, and I know that we both watch, is Bob Shiller's CAPE ratio, which is cyclically adjusted price earnings. It's currently trading at around 41 or 42 in the US, maybe the second highest it's ever been. What are your thoughts about CAPE these days? Is it outdated?
Yeah, what the CAPE does is they divide an index like S&P by the average earnings of the stocks in the index, and they use like 10 years to prevent recessions from biasing the results. Recently, it has not worked very well. Okay, like if you look at in 2015, the CAPE was 55% above the average. So in theory, you would expect low returns going forward. Instead, 2016 to 2025 was like 13% return, very positive. So it has not worked very well. And I think a recent study figured out what was the problem. The problem is that, you have the stocks in the S&P now, currently, and you divide this by the average earnings of the last 10 years. But because stocks go in and out of the index all the time, what you have is a mismatch. That is, the stocks in this index right now are not the same as the stocks in the average. So this academic group, they said, okay, let's modify the CAPE ratio. So what they did, they said, okay, we want to use only the current stocks in the index like the average. Here is all the problem. The modified CAPE is worse than the traditional CAPE, which means the news is even worse than it is the CAPE. Now, I don't want to use one metric, I guess, as standalone, like CAPE. I want to look at different angles as well. So what I did is I said, okay, the annual returns have three components. One is dividend yield. The other is annualized growth of corporate earnings. And the other is annualized change of the price to earnings over the forecast period. And I want to say, I guess, if I look at these three metrics and assume reversion to the mean, which is one of the most strongest forces in the capital markets, to see what happens. So if I assume that the dividend yield will not change, let's say at the end of 2025, the dividend yield in the US in S&P 500 was 1.3%. If we assume this will be the same, and then incorporate in the formula an annualized growth of earnings of 4.2%, which was the average of the last 100 years, and also incorporate in the formula a decline of the PE to the historical average of about 16. If you put all this together, you find that the next 10 years, the average return will be 0.4%. Almost zero, right?
The last decade.
Consistent with a CAPE. And another one that I realized about this is, this volatility anomaly where they say that even though in theory we expect higher risk to lead to higher returns, what we find is that higher risk leads to lower returns and low risk leads to higher returns. Now, lower risk not always leads to high returns vis-a-vis the high risk. The only times when the high volatility outperforms is at market tops.
Right.
If you look at the last 6 months, if you look at the last 6 months, the high volatility has outperformed the low volatility by 10%. What does it tell you? That based on the history, we're at the top of the market, which is consistent with the CAPE, consistent with my breakdown in the three components.
Okay, so when you look at that, and I know, again, one of the things that Professor Schiller has said repeatedly is that CAPE is a very good predictor of risk, but it's very poor at timing markets. But frequently, when CAPE is very high at any given point in time, the higher it is at any given point in time, the lower the realized return in the decade that follows. So the higher the CAPE today, the lower the annualized return over the next 10 years. I think I'm hearing you say something that is that you're more or less agreeing with that.
Well, I mean, like CAPE, as I said, have not worked well the last 10, 15 years.
Yeah.
And but even when you adjust the CAPE for more properly, the adjusted or modified CAPE is even worse actually than the adjusted CAPE. So CAPE says lost decade. My breakdown, the three components, says lost decade. The volatility signals that they give you, it says that we're at the top of the market. Put them all these things together, they converge.
What about gold? Let's talk about what that might mean as a long-term investment, because it had a massive run-up for about a year and a half or 2 years until about 4 months ago, and it's been selling off. What do you think about gold as a long-term investment?
Well, it has worked well, I guess, the last couple of years. People have given a lot of explanations, like the central banks diversifying away from gold, low interest rates, and so on. I mean, those who invested in 2004, 2005 in the middle of money. But history shows that gold is not a good long-term investment. It can be good in the short term, but in the long run, so if you make money, take it out, because in the long run, it's not a good investment. And if you look at historical data, this is what they tell you. I mean, if you look at the TSX Materials Index stock returns, it has underperformed the S&P, the TSX, by about 2% since the late 80s. Right. If you look at gold returns against the S&P 500, or gold has underperformed by about 5% the S&P 500. Merrill Lynch did a study a few years ago. They looked between 70 and 2007, 10 different asset classes, and they found that gold was the worst performer of the 10 asset classes.
I wonder if you could then, you're saying that it's not a good long-term investment, and that has historically been my viewpoint as well. Nonetheless, I'm using it in the here and now because of some of the things that you've been talking about with momentum. Would you go so far as to opine as to what you think of it as a short to medium-term investment?
Well, I mean, I wrote about this last year, and I said maybe it's good time to buy gold. But, when gold goes to 5,000, I say, get out of gold now. And the other thing, you hear people and commentators say, well, gold is a good hedge against inflation. Right. Well, history does not show this. If you look at, since that 1971, there were 20 years where inflation was over 3%. For these 28 years, half of them, 14 years, he had negative gold returns. So history shows that, even it's not a good hedge against inflation going in the long run, I guess. Maybe in the short run, fear, I guess, creates this kind of imbalance. But so my bottom line is, you made money, get out of it.
Okay. We've been dancing around this. We don't have a lot of time left, George. So I'm just wondering if you could perhaps be so kind as to offer your thoughts on what, as explicitly as you can, because we've talked about it a little bit already, what your expectation is for stock markets over the next decade. I know you've talked about regression to the mean and CAPE ratios. What is if you were to hazard a guess as to what we might be expecting over the next 10 years when we get together again in 2036, what would you expect the experience to be?
Well, I guess I looked at it from three different points of view, and all of them are telling me that zero return for the next 10 years. And of course, you superimpose on top of this the fact that I expect interest rates to go up, to be higher. Then in the long run, who's going to get hurt most? The stocks that drive the stock market, which is the high tech stocks. And I worry about three things. I worry about exuberance by the markets in the presence of so much debt out there globally. Exuberance by investors because they buy on margin. The margin debt is at the higher level ever. Okay? And then exuberance by corporations that are over-investing in these growth investments. And what if these growth investments don't produce earnings? Then all hell's going to break loose.
It's ironic that you should mention the word exuberance. The phrase irrational exuberance was coined by Robert Shiller, the guy who invented the CAPE ratio, and it became popular when he gave testimony to Alan Greenspan, and Mr. Greenspan died a few days ago. And so it's funny that you should be mentioning that exact word at this juncture in history, because I think it's apt. I would love to go much longer, but we're running out of time. I want to again make sure that people understand that you've got a book out called Value Investing. The subtitle is From Theory to Practice. It's available everywhere. I'll leave an image of the book in the show notes. But before I let you go, George, I'm wondering if you could offer some advice. The podcast is called Make Better Wealth Decisions. Given that where we are right now in the middle of 2026, what advice would you give people to help them make better wealth decisions?
Well, three things. First, use less debt.
Okay.
Second, get out of the speculative high-tech companies. And third, keep more cash than normal.
Good to know. Wonderful. Thank you so much, George. I appreciate your time. I want to wish you all the best, and I hope you enjoy your summer after you've had your busy work term at the university.
Thank you. Remember, I have now the book you mentioned is on the second edition now. So the
perfect.
second edition is out.
Even better. Great. Okay. Thank you.
Thank you. Bye-bye.
If you're worried about the current investment climate and your money, go to my website to book a call for personalized advice to assist you in feeling secure and protected about your retirement.